On today's show, 3 questions. Number 1, so where do we go from here? Number 2, what's the update on inflation? And number 3, how much should you be spending on vacations? Welcome to Dentist Money's 2 cents, where we help dentists navigate all the noise. I'm Matt.
And I'm Rabih.
Yeah, you are, Rabih. We keep pretending like we're going to get back to the trifecta, and we never do, or at least we're not consistently doing it. This week is because of Easter. And so happy Easter, everyone. We decided to move this up a day, give the team the day off tomorrow for Good Friday. Rabih, you were just saying this is kind of like a treat for you.
Which side is better, by the way, from your end?
First one where you're glowing.
Eastery?
You look like you're like being resurrected, like Jesus on Easter.
Eastery? Okay.
So you were just saying how this was, what a treat this was for you, because as of like Monday or Tuesday, you thought you were working on Friday.
Oh, yeah. The markets are off, but the work at DA never stops, in a sense, right?
Never.
We're always busy. But now suddenly I could take the day off, which is great,
Which is awesome. I'm working, but mainly catching up because I've been traveling a lot the last few weeks. So it's a nice catch-up day for sure. Anyway, so that's why it's Rabih and I together, and no trifecta. We decided to push this to a Thursday late afternoon so everyone could have the day off tomorrow. But let's jump in on this Easter weekend, Rabih, and talk about where we go from here. I'm not even sure what is stuff going on that people are talking about.
Well, you just came back from a vacation.
Yeah, I was shut down.
You're one of the lucky ones who was able to reset, but the people who are still working saw a tornado or a hurricane happen in financial markets last week, and now this week is just like the blank or the column after a storm, and it's like, okay, so where do we go from here?
Yeah.
A storm just happened. Will my crops actually grow and sprout in a couple of weeks, or were they dead because of that storm? Like, this is the vibe we're getting.
And really quick, Rabih, really quick side note on that. I was on vacation for the last 5 days internationally. I met quite a few Canadians. Side note by me for you, Rabih, I love meeting people on vacation. Like, I love it.
Okay.
I'm already talkative, and as you know, and I'm already, I think, a pretty happy guy. But when I'm on vacation, it's even more so, and I love talking to people. And I
should bump into you on a vacation.
Seriously, so much so, Rabih, that I've met multiple people on vacation that we ended up like traveling with them for our European vacation. We traveled with people. We met some people from Sweden. We had dinner with them. Met some people from Alabama. We ended up driving across the country with them in Croatia. I meet people, and it's like, let's be friends. So I bring all this up to say I met some people when I was in Mexico, several Canadians there, and it was really interesting to get the international perspective. One guy did tell me that people are not the biggest fans of us right now, is one thing he said. But it was also interesting. The Canadians, I spoke to several Canadians, and I apologize on behalf of I just apologize. I was like, I'm sorry. Like, wherever you land on the political aisle, I'm really sorry. But a lot of political strife going on in Canada right now as well, quite a bit. And they were giving me the rundown there. So it sounds like we're not alone. There's a lot of stuff going on in Canada. And to be honest, I met a couple who were actually big fans of Trump. They said, well, we love your guy. Yeah. Anyway, a little perspective there internationally.
It's a right versus left argument everywhere, whether it's the UK, Canada, US. I do not know how Europe is going to turn out later. But yeah, there seems to be a theme. It's not an individual. It's more of like a political current versus one another.
Yep.
Yeah. The same in Lebanon. You've got pro-Trump versus against Trump. And Lebanon has the skin in the game because wars happen on its land.
Yeah. So he's divisive all over the world, not just in America, right?
100%. 100%. So to go back to financial markets, actually, I'm going to try to not talk politics this time. Although we have and talked about tariffs a lot.
We've basically become political analysts at this point, I think.
This is a political podcast. This is about. But I'm going to try my best not to talk politics and really look at it strictly from financial assets and economics perspective. Because, at the end of the day, we're here standing on the side of investors, and we want to take that outlook. So there's no structure today. Let's just do a medley to collect data. Let's see what we...
Is there ever a structure here?
I try my best, but good to know.
You have a structure, and then I'm just here. Yeah.
No, you keep me stuck to the clock. You don't let me nerd out too much. So we'll look at stocks and how they did. We'll also see what the data's coming in for, the unemployment, the inflation, the economy, the consumer, the government, the exports, imports. Like here and there, let's see what the latest data has been. Do they tell us a certain story, or are we at the mercy of news channels? That is what I wanted to get to. So in what I have first, actually, let's start with stocks. For the last 5 days, we're recording this Thursday, so it's like from last Friday until the Thursday before Good Friday, the S&P 500, with all its volatility up and down, has only made 0.35% movement. So it kind of flat. I would call it flat. However, the rest of the world, especially developed markets, just had an amazing week. So heads up for a globally diversified portfolio. Yes, you said, oh, they're dead, but it doesn't look like they're dead, and there might be a narrative. We'll get to it in a second, but we got China only going up around 2.73% for the week, and then we got Vietnam at 3.6%, and then we got South Korea at 4.8%, Japan at 6% in 5 days, Canada 6% in 5 days. United Kingdom 6.6%, and Mexico 9.2% in just 5 days.
Whoa.
So those are huge movements. And it is very interesting to see that in the equity market. If you just look at it, you'll say, well, either the companies in those countries have been performing really well, or the Federal Reserve, central bankers in those other countries decided to cut interest rates. This is what usually, when you compare equities to equities, might be the reason for why one side of the world will do better than the other side of the world. But there is also a third one, which is like money flow. Are people actually taking money out of the US and putting it into developed countries? And it seems like the narrative is that central bankers, although the US has been stuck and they did not cut rates, they haven't been cutting rates, while the rest of the world has been cutting rates. That is helpful for global equities. And earnings season just got started. We're in like this second, third day, so that's not meaningful enough for equities to move. If it seems like money is moving out of the US to the rest of the world, especially in developed countries. And if you notice, China and the US both were muted in performance compared to the rest of the world. So it seems like money, it's just like, oh, we're against the US, we're running out of the US. More of, we're running away from the areas where there's trouble. So US and
from
China,
this battle, it's basically just become a US versus China battle at this point.
Yeah, so money is hiding on the sidelines.
Yeah.
And when it hides on the sidelines, it elevates wherever it decides to park. And this is what we are seeing. So that is interesting to look at. Will looking at the currency and looking at bonds and interest rate validate this narrative? And we'll see in a second. But my hypothesis is I think so too. But this doesn't mean that the US is in a bad shape. The S&P only moved 0.35 for the last 5 days. We're down around 13 or 14% from the all-time high. And the PE ratio, which is the price over earning, a measure of valuation in the market, has dropped down to 18 around, if you round it, it's 19. So to 19. The all-time high was 23 in February, which was like, I wouldn't call it a bubble, but bubbly. It was
starting
elevated.
to simmer a little bit. Yeah.
Yeah, it is like 23 forward PE is, you're paying 23 times in price for those earnings. Historically, the long-term average has been around 16 to 17. So 23 is on the high end. A 19 to 20 is like, those are positive indicators. We're in a bull market. 23 is a little bit too much. So we're at 18, 19. Yes.
So can we just back up really quick, just so people out there, because we've referenced this before, and I want to just make sure that people listening understand when you're talking about private or the PE ratio, this is the ultimate, whether we're not going to get into the topic of like people who can argue, I think rational minds could argue like the viability of this metric as being like really accurate. But when people out there, you might hear out there, stocks are expensive or stocks are cheap, they're referring to this metric, right, Rabih? It's the price to earnings. It's the most universally accepted ratio around this concept of stocks are expensive or stocks are cheap. And it's just actually, can you break down, it's taking basically the price and it's price to earnings. So it's actually taking the price itself and comparing that to the earnings of those particular stocks. Can you break down how that's actually calculated?
Yeah. I love it. So every single, fiscal quarter or fiscal year, what's going to happen is that you're going to get an income statement. And it's like the equivalent of your P&L if you have a dental practice, right? And then your net income on the P&L is also net income on the income statement. And that net income, you decide to divide it by how many shares the company has outstanding in the market, because those are publicly traded firms. If it's a dental practice, it's you and your partner. So you divide it by you or 2 or 3, etc. So let's assume a company has 10 million shares outstanding. They divide that income number by the 10 million. And in that sense, you get your earnings per share. But also, the price that you see on the stock market is the price of the equity, but it's the price per share as well. So the denominators kind of cancel each other. So you're looking at the price per share and you're comparing it to the earnings per share. And usually, just like you're going to be selling a dental practice, for example, some people use EBITDA, some people use net income, etc., whatever it is. You are seeing the price, how many multiples of the earning it is, how many multiples of the EBITDA it is. And when we're saying the PE ratio is 23, is that the multiple right now is 23. Price of the stock is equivalent to 23 times those earnings that were just made on an annualized basis. So this is how they look at it. And usually, historically, when you purchase stocks from the stock market, you buy them at 17 times their earning. 23 is a little bit too much, according to the historical data.
And now we're at 19 currently.
We're now at 19, which is a healthy sign, And if we still want to push forward the idea that markets are efficient and they incorporate all future prices, well, if we think that we're heading into a doomsday scenario, they wouldn't be at 19. They would be much less, right?
Yeah.
So at 19 kind of gives us some information that, yes, it's lower than the 23, but we're not heading into a wall yet. It's not a certain probability that we're heading into the recession, etc. A slowdown is there.
And then, Rabih, really quick, just on this, I don't want to deviate too much, but I'm just genuinely curious. When we're talking about, of course, it's dropped from a 23 to a 19 because prices have come down. That's just a natural, but to your point, it doesn't mean it's a doomsday scenario. But because it's earnings season, we actually don't know what this is yet, or this could adjust even more so now, right?
Yeah, I love it that you said you don't want to deviate, but you went directly into the next topic.
Yes.
Which is great because
we're professionals. We are professionals, yeah.
So we said that earnings just started and we only had, a bunch of financial companies start reporting earnings. And the actual earning number isn't as important as much as the forward guidance that those companies say in their press conference about how they think their revenue is going to be like, etc. No company so far has went on and said, we are firing people today, we are taking these measures, we are doing, etc., because a recession is coming and we need to hold tight. No company has said that. But a lot of companies have said that we are in an uncertain time and we are taking precautionary measures in terms of fluffing up, making sure we have reserve cash on the side, because it is uncertain and a recession or a decent slowdown is on the table. Most of the companies that reported this week were financialists, actually. And it was very interesting because banks do not decide to hoard their inventory. They deal with money. And they have something on their income statement called loss provisions. So how much money they are allocating on the side that they expect to lose. And JP Morgan actually increased it from 900 million to around 2.3 billion. So it is, but also they manage trillions of dollars. So
it's all relative.
If you relatively, it's there, but they are increasing their loss provisions and how much they expect to take a hit. So companies are expecting a slowdown, a hit for profits, probably some revenue that's not going to be collected, but they're not really affirming that a recession is there, and they're just preparing for either scenarios. It was very interesting that United Airlines, when they were reporting, they gave out two forecasts for their revenue. A revenue for baseline scenario where profits are doing well, and a forecast for if a recession happens where revenues are slashed by a certain percentage. And the fact that they chose to provide both to analysts tells you that even CEOs are knowing that it's uncertain and they do not know. So it's going to be very interesting to see how the year pans out and where we stand.
Which is not shocking, right? Because if you just look at right now, obviously the thing on people's minds, I know we said we were going to go here, but I think it's important to talk about really quick, is tariffs, right? How could they know when the tariff policy changed 6 times just last week. I mean, you go to bed last Friday and wake up on Saturday and it's changed again. And so I don't blame anyone for anybody, analysts, company CEOs, or whatever, saying we have no clue. Because is it going to be a 10% tariff, or is it going to go to 145%? And now there's caveats, and actually electronics are good. Like, I'm not making a comment on the strategy itself. I don't know what's happening, but just the result is nobody knows what's going to happen. And the fact that it changed so much, this could all be done by next week. There could be an announcement that they have new trade policies and it's done. So I think it's almost impossible, more so than ever, to actually know what's going to happen or making projections going on into the rest of the year.
I agree. So it is very uncertain. And here's the annoying part. We have to wait until data comes in for us to start knowing. Like, we are just 1 week after that storm, and most of the economic data that we're receiving are related to March. Like,
yeah.
What happened before April 2nd is not the same as post April 2nd, right?
Exactly.
So it is interesting. And that is one of these stuff that is showing in. We only had a couple of data points this week, and next week is going to be the same. But in 2 weeks from now, we're going to get the Q1 GDP advance. We're going to get unemployment and job openings. We're going to get new inflation numbers. So 2 weeks from now, it's going to be a really good time to reassess data. But so far, we only got a little bit of stuff. We've got some consumer confidence. We'll get to it in a bit. But we got retail sales. And retail sales for March came up strong at 1.4. Just to give you, October, November, December, it was between 0.5 and 0.7. January is -1. February is 0.2, so flat. But then March is 1.4. So, like, how come suddenly retail sales jump up? But one out of these 1.4 is motor vehicles and parts, which is interesting. I think this mimics the behavior we've seen in companies trying to increase their imports ahead of the tariff deadline on April 2nd, trying to increase their inventory. A lot of people had on their mind that, oh, should I buy a car now because they might be expensive? It seems like people went ahead and did it in March.
Yeah.
It seems like I
got messages about this. Yeah.
There were people that went out there and bought parts and car parts in March, and that is where it's showing. So if you exclude that one that's coming from cars, you're at 0.4. So it seems like retail wasn't affected yet. So if we think tariffs are gonna either cause inflation on the long run, or it'll be just a one-time bump of price levels where they increase, we're not gonna feel it until we go into Costco and suddenly something that we buy is 20% more, or you go into Home Depot and something that's imported from China is 100% more. So it'll take a while, and it'll take until those show in the data. So the data is still showing a very, very strong economy, but those are lagging. And it's very interesting. I'll let you comment here before I transition.
Well, just to your point around the spending, A, it takes a long time for it to show up in the numbers. B, again, we don't know where this is going to go, and this could be solved by the end of this month. We have no idea. But the other thing, to your comment about spending, I mean, we saw this in 2022 and beyond. We've been kind of joking about this on this show for the last couple of years. When inflation went crazy for a couple of years, spending did not change. The numbers just kept showing that people kept spending money. And now, again, at some point, something's going to stop the American consumer or slow them down, slow us down. We're just as much a part of the problem.
Matt goes on a vacation for 1 week and he decides to
slow us down. You're never going to slow me down. But no, I mean, at some point, something's going to slow us down. But I'm not even so sure you were going to see like, people just keep spending, Rabih. They're going to complain about it online, but they're going to keep spending money.
Honestly, I think the administration would be betting on that because, as we have just said, data is lagging. But who depends on the data? The Federal Reserve.
Yeah.
So given the current rhetoric that the Federal Reserve is taking, which is we are data dependent, and this is what the Federal Reserve said yesterday on Wednesday, it's becoming harder for us to try to balance between growth and inflation, but we are in a position where we can take our time to have more clarity, which means they are data dependent, which means if it starts going in a bad direction, the Federal Reserve wants to see it in the data before they intervene. So that you can call it volatility, you can call it market opportunities, you can call it some bullying from the president to the Federal Reserve.
Yeah, he's frustrated. He's trying to get him to cut right now.
It is going to get the cut right now. And I have a really good chart and data for why they're trying to do that. So
we just transition again?
dude, we did it. This is like the third time. This
My gosh.
amazing.
Okay.
Amazing. So we just looked at the stocks and what happened. Usually when the stocks go down, like we have been seeing, and now the conversation is not only about the last 5 days, but about the storm. During the storm, we saw them go down severely until they decided to postpone for 90 days those reciprocal tariffs. When usually that happens, you see equities going down, but you also see interest rates go down. Or in a sense, bond prices go up. And that tells you people are afraid that there's going to be a slowdown where they're going to sell their equity and buy bonds. So you'd expect equity to go down, interest rates to
Bonds
go
to
down,
go. Yeah.
or bonds to go up. This is not what actually happened. There's been quotes, and any financial analyst that I talk about, it's like presidents are not afraid of anything but bond markets. Like bond markets are more important than any president on any country combined. That even Federal Reserve people are afraid of the bond market because you're talking in the amounts of whole economy is moving. Like the amount of money that is moving is
Yeah.
in the multiples of the trillions. So it is scary. So what happened is that equities fell down, but bond yields went up, which is a panicky mode. Like you're expecting if equities are going down, people are going to move from the riskier asset to the less risky asset, buy the bonds. This is not what was happening. And then that was the first kind of question mark between the relationship that broke. The second relationship that broke is that when interest rates go up, usually the US dollar goes up, because when interest rate goes up, foreign investors are saying, oh, now we can put money in the, between quotations, the safest economy in the world and get a higher return than we usually do on like treasuries, which are supposedly to be the riskless securities out there. So
But this
when
also did not happen.
that did not happen, bond yields went up, interest rates went up, or bond prices went down, and the dollar also fell, which was the second question mark and probably the major question mark on everyone's mind right now on why it happened. I do not know if it's timing, if it's not, but if the administration was, making sure that they want to prevent the economy from crashing, this is what they were looking at. And when they saw that linkage between higher interest rates and a higher dollar kind of went in the opposite direction, the interest rates went up and the dollar went down, they decided to back out of the, economically speaking. I'm not saying that their plan that other people decided to negotiate is not working, but economically speaking, that was scary. That would cause a depression. Like this, you would not want interest rates to go up and your currency to go down at the same time. That's doomsday. So
do we know what, I know there was warnings by China saying that they were going to do this, right? Like they have the power to do this because they own much of the federal debt.
Dude, I love it. Where is the picture that I took? It's not showing up, but I have the information memorized. I wanted to know who was selling, because when interest rates go up, it means people are selling bonds. I wanted to know who was selling the bonds. Was it other countries? And by the way, in terms of holding, you've got Japan holding the biggest amount of US treasuries, around 1.1 trillion, followed by China's holding around 800 million. Then you've got Canada, then you've got Vietnam, etc. But Japan and China are, but also it's 1.1 trillion. If you add them all up, it's like 8 trillion. But the US debt is 36
trillion. Yeah.
So you are the remaining amount is held by us, the US consumer. So it's, and the government between itself, like Social Security counts into that, etc. So I wanted to know, like, who is selling the bonds? Is it these governments? Are they trying to Trump? I said I don't want to talk politics, but Trump wanted to raise tariffs. They decided to sell bonds. Is this what is happening on the global trade war scale? The data is not going to show up until probably May or June. I just opened the Treasury website, and this is the good thing about the US. Everything is transparent, so we can track the numbers once they show up. In a couple of months, we'll know exactly who decided to sell the bonds and cause that exuberant panic in the markets. Probably not other countries, because it is too big of a card to deal right now in terms of like negotiations. Something that has been showing up is that those are hedge funds. Those are hedge funds that have been very leveraged. They've been leveraged since February on the all-time high. And they're not leveraged equities. They're not doing that much. They are dealing between the treasury market which it's called the secondary market, where you and I can go buy treasuries after they have been issued, and something that are called like overnight rates and future contracts on these treasuries. I'm not going to go into details; they're complicated even for professional investors. But it's called a cash swap basis trade or a cash futures basis trade, if you want to Google them. But those are trades where you are hoping to make some little money on arbitrage, but then you decide to leverage them up 50 times, not 1 and 2, 50 times. And when interest rates decided to go up, whoever is servicing those hedge fund strategies asked them for more margin because, volatility happens. So they had to deleverage a little bit, sell a bunch
Liquidate.
of those bonds to be able to maintain their account before having to.
They got called, basically.
They got called. Probably this is where it is. And we'll see. Because if it is country, I don't think the administration will touch that button again. But if it was just hedge funds and the crisis was avoided, probably the administration might repress that button.
Go back.
Again. So we'll see. We'll see. And that's why we are waiting for data.
Although I wonder, Rabih, just to that point, let's say it's hedge funds. That seems like you're saying it's the most likely scenario for now, because that'd be a pretty big bet and a pretty big move by these other countries to do that. Although, they're probably just matching the current administration's approach, and they're just like, you're going to be this aggressive. Like, I could see China doing that, just saying like, we're going to show you what we will do back. But even if it wasn't other countries, I do wonder, to your point of, if the current administration realizes it was not other countries, and so they might press again. I actually wonder if it would make them even more gun shy to press again, because again, assume it's the hedge funds. They just gave them the game plan. You want you want the administration to back off. You want Trump to back off. Go devalue their currency, sell all the bonds that you hold, and basically put them back on their heels. I think either way, this might make them a little bit gun shy no matter what moving forward.
It's true, because you showed them, and we discussed this like 2-3 podcasts ago when we said like, what is the ceiling on tariffs, what's the upper limit? And the upper limit is because what we said, a trade deficit means that you're getting more products from the other country. But if you look at the other side of the transaction, this means you are giving that other country your dollars. What are they going to do with it? They're going to buy treasuries. They're going to use it as a reserve currency. So if you decide to stop buying from them, it means you're stop giving them money. This means that they're going to stop using the US dollar for other stuff, which threatens the position of the US dollar as a reserve currency. So where is the upper limit? I'm still on that opinion. The upper limit on this tariff and trade war thing is when the status of the US dollar as a reserve currency is severely threatened. So this is where it's showing.
But and this was a glimpse of that. We got a little glimpse of that. Not maybe the whole thing, obviously, but it obviously showed us backing off, because we were like, oh, like so Trump has said.
Yeah. So far, it's a very... Go ahead.
No, it's like Trump has said he's okay with a recession, but you use the word depression. Like, they maybe got a glimpse of like, oh man, if this pushes further, this could be even worse.
Even the president, the day he decided to postpone the reciprocal tariffs for 90 days, he said, I'm okay with a recession, but I do not want a depression. That is a quote.
Yeah, of course not.
So it is very important. And they have to balance. So far, it's a valid hypothesis that, this is part of the trade war happening in the background. And it only depends on data until we know in which direction we're coming. I'm hoping it's just some greedy hedge funds that decided to, unwind some trades, and even if at the expense of everyone's 401k, but they decided to unwind some trades. But what we know is that higher interest rates are not in the benefit of the US government, regardless of how they are forming, whether they are hedge funds unleveraging or whether it is pressure from foreign governments and central banks deciding to sell their holdings of US treasuries. Because while we're still talking whether the deficit is going to be balanced, etc., you have a big amount of debt, the federal debt. The amount of interest that the US has been paying on its debt is now more than we pay for the military, which is, I'm not going to go into the numbers, but it's very high. And if you look at the total debt is 36 trillion. In 2024, the interest rate on that debt, like you're paying, the US paid 2.35% on its $36 trillion of debt. That is how much they paid. And it's only 2.35, kind of similar to people who locked in a very low mortgage. It's like they were borrowing when interest rates were lower. But a lot of this debt is maturing and they have to reissue it. And they're going to be
9 trillion
reissuing
in
it.
2026, right?
Yes. Every single year you got a really good, but 2026 is a big year for this reissuance. That's why they want interest rates lower by then, because they don't want to reissue new debt at a higher interest rate. But I was looking at this chart and assuming they decide to issue at current market levels for 2025, their interest, effective interest rate, on all the debt on this 36 trillion will move from 2.35% to 3.32%. This means it's going to cost the US government $354 billion extra just paying interest on that debt. So from the perspective of a government, if you're trying to run a tight ship, you know that if interest rates stay at this level for the next coming time, your expenses are going to increase by 354. That on top of a slowing economy, probably from a tariff, because as companies are saying, they do not know, more and more is pushing and pointing fingers towards we need interest rates lower now.
Which is why Trump's pushing so hard for them to lower.
So we'll see. The Federal Reserve is saying we'll sit and wait. The market, Fed funds rate that we always reference, is now, the Fed is still saying that probably 2 cuts, a quarter in June and a quarter in December. I don't think that's on the table right now. The market is pricing 3.5 cuts by the end of the year. And by March next year, so 12 months from now, 4 cuts. So 1% lower. So honestly, 1% lower might actually not increase. So we'll see. There's going to be, in terms of the economic infrastructure of the US, companies still know they're everything and produce great products. Innovation is still there. The US is still a country where there are entrepreneurs that can create any type of product and service. So the infrastructure is still good, but we are bringing down some walls, putting some windows elsewhere, and it's going to be a little bit turbulent. Politically, the relationship between the central government and the central bank, I'm expecting to see these, but for a long-term investor, especially for a long-term globally diversified investor, those are market opportunities to buy. There is uncertainty coming. That's why the VIX hasn't dropped below 30, although we're a week after. But now we kind of have a sense of what we are reading and what does it indicate. We know that money is kind of running away from the headbutting US and China. We know the interests of the government of keeping interest rates low, and we know that the Federal Reserve is waiting on lagging data. How will that pan out in the couple of months, probably year, is going to be a learning opportunity for everyone because it is interesting,
Yeah, it's really cool. A lot to learn here, a lot of uncertainty. But to your point, we cannot emphasize this enough. Like most people listening to this show, it's like, what should I do? Should I be changing my strategy? Should I be doing something different? The answer to that is no. Like, hopefully you've got a strategy or a system set up for the long term. And the only reason you'd ever make changes on any of that would be your own personal life, right? It wouldn't be like anything to do with foreign policy, anything to do with geopolitical headbutting, as you put it, with the US and China, because that's an impossible game to win, right? I mean, again, Rabih, just look at, you've already highlighted it over the last 2 weeks. What's happened with foreign markets specifically? What's happened with the foreign or the foreign developed emerging? We were touting global diversification. We were shouting from the rooftops. Then I had a really rough week. And now look what it did in the last few days. Anyone out there thinking that they can like reallocate in time based on these things, you're going to lose that game every single time. One thing I wanted to ask you though, as you were going through that. So one differentiation, again, we're talking, this gets really confusing for people for good reason. I think you go through what we just went through and I'm like, holy cow, I can only imagine people's heads spinning. But the Fed funds rate, what the Fed controls, again, is the short-term rates. That is different from what you referenced earlier, being the treasury rates or the interest rates on the outstanding bonds or what the government issues. How much would you say, Rob, because I've heard this out there, this theory kind of out there, of this part of the motivation of this, the tariffs being preemptive to thinking what you've already said, what we thought would happen, what normally happens is bond prices go up, yields come down, providing an opportunity to refinance those at lower rates. How much of this, in your opinion, was motivated by that possibly?
So
and it just worked. We just got the wrong bet.
Yeah,
or
so
bet wrong.
if your goal is to slow down the economy, to force monetary policy to be lower, have lower interest rates so you can refinance your debt as a government at lower rates, is tariffs the right way to do it? You want to bring revenue? Just I know it's not a Republican thing to do, but increase taxes. Increase taxes that will definitely put the economy into a recession. The government will have money and probably balance a budget for a year. Interest rates will be lower. You will be able to kind of refinance your debt at a lower rate. There are the tool to slow down an economy, if that is the goal, so you can have lower interest rates. The toolbox is big. It could be tariffs, it could be taxes, it could be stricter regulation that would bankrupt a couple companies and put us in a cycle. It could be just someone going on the internet and freaking us out, so it's a self-fulfilling prophecy. The tools to slow down the economy are plenty. The Federal Reserve can just go and say, we decided to not cut interest rates at all this year. And that would, from the perspective of businesses, would become restrictive policy and would put the economy into recession. So the toolbox is full of stuff. I do not think the goal that tariffs was the only goal, like what we mentioned is the only goal of tariffs. I think they were trying to hit not two, but multiple birds with one stone called tariff. Some of them will land, some of them won't, and they'll fall on someone's head and hurt.
Hopefully not ours. Yeah. Yeah. No, that makes sense. I'm glad we went through that. Rabih, we did one question, and I think we might just tease the other two for next week.
We could.
That was a lot. So maybe we just, I think that was hopefully helpful. And I think it was so much that I don't want to basically make people's brains numb.
I'm sorry, I told you it'll only take 20 minutes, but we're 40 minutes.
I thought it was good. I genuinely think it was helpful to go into those, kind of go off into those different, down those different roads. So let's just leave it there. I think from what I've heard, one of the other strategies of tariffs, we'll see if it works, is to get people to the best. What I've heard is the best summit, the best dental summit of all time. And so we'll see. That was on the list. I think I heard the current administration talking about this. And so we'll see if it works to get people. So far, it's looking good. It's looking good. We have quite a few people signed up. There's still some spots available for, again, what I've heard is the greatest dental summit ever. It's called the Dentist Money Summit in Park City, Utah, June 20th and 21st. Rabih, how was that one?
Dude, I think you caught me off guard the most this time.
Yes.
Usually 2-3 words into it, it's like he's doing the summit transition. This one, I was like trying to think of an answer. I'm like, what do I
Your
answer?
brain's like, you're like, where is he going with this? Just try to be as silly as I possibly can. We have fun. We truly would love to have you out to the Dentist Money Summit in Park City, June 20th and 21st. Full new slate of speakers, different from last year. The theme is planned for the present. We have, again, tons of like-minded dentists just like you out there. You can come meet the team, come meet Rabih. We're going to be there. Are we doing a 2 cents this year? I think we are, but I don't know if we're going to do it on stage. We do. I'm not sure, but I think we're going to record some stuff there. We'd love to have you out. Love to meet you. So check it out, dentistmoneysummit.com. Rabih, thank you for being here. We really set the bar high saying we were going to talk about 3 questions. We only hit 1. That's the opposite of what we should be doing. We should be under-promising and over-delivering.
Yeah.
Today we did the opposite, but everyone, thanks for listening nonetheless. That was our 2 cents. Till next time. Bye-bye.